Welcome to the Healthy and Wealthy Retirement, where your certified retirement counselor, Mark Struthers, takes a holistic approach to retirement, going beyond finances and embracing holistic well-being. This YouTube channel will address not just the financial part of retirement, but also the social, the physical, and the emotional parts of retirement. Everything you need for a healthier, a wealthier, and a happier retirement. Here is your host, Mark Struthers.
Welcome to the Healthy and Wealthy Retirement. My name is Mark Struthers. I am your host. This video is a follow-up to the one we did on the sunsetting of the current tax code. So as of 2026, the TCJA, the Tax Code and Jobs Act, will set to expire. We talked a little bit about things you could do in a previous video. I was at IWI, an Investment and Wealth Management Institute conference in Vegas here just recently, and the expiration of the TCJA was a major topic. I want to say, boy, I don't know, at least 2-3 presentations on this. There were some really good graphics and things that I think I do a good job. I think those who work for me do a good job. But there are some graphics that honestly, I'll be honest, did a better job. Also, quite a few of these went into a lot more detail as far as gifting goes. So the previous episode, we talked about Roth conversions. We talked about possibly moving income around. Today, we're just going to talk a little bit more about gifting. And also, I'm sharing some of the graphics, giving them full credit. We're not going to take time to redo them. But the first one I'll flash up here, it shows the federal tax exemption amount throughout since 2017, and then what it is set to go down to in 2026. I found this very helpful. It gives you an idea of the kind of the inflation growth that caused these numbers to change. But you can see here, 2025, the expected exemption is over 14 million, expected to drop down to roughly half of that in 2026. If it expires. Now that's per person, so 2 couples would have twice that. Doesn't affect a lot of people, but if you doesn't affect a lot of people, but if you are up near that asset level, also there are a lot of people who, especially in their 40s, but even 50s, that when you project out what their net worth might be, they might have $1 million in a 401k now, or 2 million, but certainly once you get up to 3, 4, 5. They could easily be there even if they pass in their 70s. It all depends on growth rates and taxes and so forth. But you get the idea, and I thought I would share this. I circled the graphic on the plane back. So I was flying back. It was the middle of the night, so forgive me if that's a little sloppy. The next graphic I have here, it shows a timeline. I thought this was a really good idea. I wish we would have come up with it. So it talks about pre-TCJA and then the years of TCJA, and then assuming it sunsets, no guarantee it will. And actually, I'm leaving in here what it's telling advisors we should do. So forgive me for the kind of how the sausage is made behind the scenes, but there is some really good stuff here. And education is a big one. That's what we're doing here. That's what I'm trying to do with clients. Trying to get clients to, especially if you're still working, to think not just about 2026, but if this expires, and who knows, they could renew it and then have it expire in 5 years, 10 years, and you'd still have this issue. But it's important for clients just to think that not what their net worth is now, but what their net worth might be in 20, 30 years, so you could take time to act. I'm going to go back to this previous chart. Also, another thing on the chart I initially showed, and we'll flash it back up here. The gift tax amount, the annual gift tax exclusion amount. It's $18,000 now, probably going to $19,000, and that's per person, and also that's per person they're gifting it to. And at the end here, I'll flash up that a couple can actually gift away a lot of money. I mean, really think about whether you want to do this. Really think about what's the benefit long term, but it's something that should be considered. and we'll go back up to this timeline here as far as things that you can think about, realizing that now's the time to act, now's the time to consider acting. Again, the government could come in at the last minute and change this, but I have suspicions that regardless of who's president, the Senate might not be on board with this. Not an expert in government legislation, but just keep in mind that it could be challenging to actually get everything fully renewed. And again, it's more about making an informed decision. It may or may not be right for you. The next graphic I am pointing to is ways you can gift. So direct gifts, which are unlimited. And because we try to keep these short, I didn't mention this in the previous presentation, but I might have. If I did, I touched on it. Tuition and medical expenses. It's not deducted from your lifetime exemption or the annual exclusion amount. That one is overlooked, and we have a list here. Again, put some thought into it. Consult your tax professional or financial advisor. The annual gift exclusion amount. That includes contributing that counts as a 529 contribution, an education fund. 529 plans are, part of the reason people like them is because they're not included in someone's estate, yet the person who owns it still has control of the assets. Did a little blurb piece in Barron's years ago on this. There's downsides, but it's something to consider. And then the last point here is just reiterates the federal estate tax exemption amount that we already talked about. Thought these graphics were really good. Normally we don't put a ton of graphics in our videos, but some of these I thought were honestly better than the ones that we often come up with, although I think ours are more colorful. Next up, we have a chart of how to avoid the gift tax with the 529 plans or the Roths. Again, the gift tax amount is listed there. You don't want to be hit with that. Obviously, the government is onto the fact that people could try to transfer income from parent to child, and they have things in place. It doesn't mean you still can't use them. But 529 plans and also 529 plans for using for K through 12, there's limits on that, $10,000 per year, and now 529 plans can, with certain limitations, be turned into Roth IRAs. And also just Roth IRAs, if the child has a job, even if they're spending the money, having the parent, in essence, fund that Roth IRA. Roth IRAs are great for kids for a lot of different reasons. Contributions are available anytime, tax or penalty free. Again, ideally, these are for retirement accounts, but they can act as college funding or an emergency fund. In essence, be careful what you invest in. Most financial aid calculations do not look at Roth IRAs, whether they're owned by the child or the parent. They don't look at retirement accounts. Once you get into some folks who use, in my opinion, the CSS profile or consensus, once you get into some of these schools, usually they're private, often more expensive. They take a more holistic view. A lot of times they'll ask for this stuff, and the FAFSA might not. I don't believe for a second that they don't in some way take into account. If they have two students who are identical, and one has $1 million Roth, I think that they do take a look at it. Just my opinion, but technically they're less likely, or they're less likely to take a look at the Roth IRA, whether in child ownership or parent ownership. Also, this next graphic I thought was great. It looks at the annual exclusion amount and how parents can gift quite a bit. If it's $18,000 per year per donor, it's $36,000. So parents, say my two boys, we could give $36,000 to one child as a couple and $36,000 to the other child. If you start early and you want to get money out of the estate, you could gift a lot. Keep in mind, you got to be careful as to how, if a child is ready for it, it's just the best thing. Remember, these are irrevocable. In almost every case, they're irrevocable. in the case of a 529 plan, if you're the account owner, you still have control over it. There might be some issues getting the money out, and if, as far as taxes and whether it's moved back into the estate. But if you come up with a plan as far as what your wishes are, and the control of taxes is what most of this comes down to. And also, and you throw in if the child is too young to have the money, or even if they're older. I'm going to throw up a quote from Buffett here, again, from the same conference I thought was really good. Before I do that, charitable structures, thought this was great. They show direct gifts, philanthropic structures such as donor advised funds, which you don't have to be super high income to take advantage of a donor advised fund. You need to get some details and consult a professional. You get to the right, you get the more complex things such as split interest vehicles, CRUTs, charitable remainder trust, and charitable lead trusts, private foundations. Most of those, most clients don't need them, but some would. And then lastly, I'm going to show those in Minnesota just to show you what you're dealing with. As far as taxes, we have one of the highest income tax rates in the country. You see here, we're red. We're not the super dark that you see for California or New Jersey or Washington. But we're pretty dark up there. So we're in a high tax state. And when it comes to, and this came across smaller, when it comes to the state exemption amount, Minnesota's fairly low for the state taxes at $3 million, and it's not portable. So for people in Minnesota, some of this they might want to do just to avoid that Minnesota estate tax. Lastly, I'm going to throw up here a quote from Buffett I thought was really good. The perfect amount to leave to your kids is enough money so that they would feel that they could do anything, but not so much that they could do nothing. So I think as you go through this, you need to think about control, taxes, your wishes. But if you're leaving money to younger children or adult children, just put some thought into it. As those who work with me know, I'm not really a pound the table, you have to do this kind of guy. I have a lot of respect for people's values, whatever they are. But the biggest thing I like for folks to do is make sure that they know the possible consequences and they put thought into it. I like for folks to make an informed decision. And, I don't think in terms of good or bad. If you want to leave your kid $10 million, God bless. But as long as you put some thought into, the taxes involved, and just whether it's good for the kid, does that go along with your wishes? Put some thought into it, and take your time, plan ahead, and take your time making the decision. So I hope you found this follow up to our TCJA sunsetting worthwhile. Please hit subscribe so that you can have a healthier and wealthier retirement. And we are going to have I'm going to do some other videos here, things I picked up at the IWI, the Investments and Wealth Management Institute's conference. Some really great stuff. A lot of conferences I pick up good stuff from, whether they're XYPN, NAPFA, or what have you. But I did feel like there was a lot of good stuff at this one, not just for higher net worth folks, but for folks from really almost any income level. I thought there was something there for everyone. I'll be honest with you, I was a little suspicious going in. I'm not really involved with this organization because they are so high net worth focused, even though I work with several high net worth people. But I did found the people great. I found the technical content really good. Stay well. Don't forget to subscribe.